Hello investors, my name is Kruse. I'm founder of Kruse Asset Management, where we make investment decisions based off of math and statistics. Said another way, we think using your head and not your gut is a better way to make more money for you. Welcome to today's installment of 60-Second Investing. Today's topic is going to be, hey, are we in a bubble or not? I mean, we have some very lofty levels right now. The S&P and the Dow have hit all-time highs. So you've got to be concerned whether we're about to fall. Should I pull all my money out of the market and head for the hills, or should I stay in? Well, let's give you some context. It's been 9 years since the market's been in a recession. It's been 9 years since we've had a pullback of just an average top to bottom drawdown of 16%. So maybe we're due. And while we could have a pullback at any given point in time, I would like to offer you 3 reasons why I think this market is not done going up yet. Number 1, PE ratios, or any other historic ratio where you can value the market. Long-term averages might suggest that we are slightly above fair value, but we are not in bubble territory. Our friends at JP Morgan took a look at PE ratios, and the 25-year historic average of forward PEs is 16.0. One standard deviation at 19.2. 2 standard deviations is bubble territory. We are 17.7. We are a half standard deviation above fair value. So nowhere near bubble territory. Number 2, we are in a low interest rate environment. The 10-year treasury is actually below 2.4%. And the Fed has been struggling to raise the overnight lending rate for years now. And again, we're still at historical lows. Low interest rates allow for higher PEs and greater PE expansion. Now you might argue that if PEs and interest rates start going up, PEs will contract and drive the market down, and that might be true, but we certainly haven't seen that, and people have been calling for that for 5 years, if not longer. Item number 3, and possibly the most important item, euphoria, or really lack thereof. I don't know about you, but I don't get into an Uber driver and have them tell me a stock tip that I need to have in order to make a bunch of money, and then having a conversation that they're about to quit their Uber driving because they're making so much money in the stock market. The S&P and the Dow are not dominating headlines these days. That's usually what it takes in order to get into this phase of euphoria, which precedes every bubble there is. So by definition, we're not in a bubble. And that's usually the most important item of whether the bubble is about to burst. We have a healthy level of skepticism. Even this very video is suggesting that people are concerned that the market is too high. And I will remind you that when Alan Greenspan used that phrase irrational exuberance back in 1996, the Dow was at around 6,800 and proceeded to go to 14,000. Because he thought we were overvalued, but we were nowhere near euphoria. It had doubled since then. So what does that mean? I'm not going to say the market's going to double from here, but I'm also not going to suggest we are in bubble territory. We should have pullbacks along the way. I would even expect, if I were you, an average pullback, top to bottom, 16 to 20%. Thanks so much for watching. I hope you'll like our page on Facebook and LinkedIn and our YouTube channel. And if you have any comments, please post them below. We'll try to get to every one of them. And if you have any topics for the future that you'd like for us to address, please let us know that too. Thanks again. I'm Kruse with Kruse Asset Management.